A policy is either structured and intended for the infinite banking concept, or it's not. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's installment of our EncycloMedia series, we're going to cover the proper structure in a properly structured whole life policy with a mutual company that pays dividends for the purpose of infinite banking. So as always, I'm going to refer you to the book, Becoming Your Home Banker by R. Nelson Nash, to know more about what I mean when I say proper structure. But certainly a policy must be structured for the purpose of banking if you're wanting to become your own banker, if you're wanting to implement infinite banking in your life. So when it comes to a policy's structure, that means you are going to have rights and obligations. So contractually, with a properly structured whole life policy with a mutual company that pays dividends, you will have contractual obligations. The obligation will be the premium. Okay, so you pick a premium amount and you will pay that premium amount to own this type of a whole life policy. And then also in that structure of the policy, you will have contractual rights, and those will be several. Having the contractual right to a certain amount of death benefit, having the contractual right to pay level premiums over your lifetime, having a contractual right to access a significant amount of cash value early in a policy, immediately. In fact, in a policy, and immediately, for me, the definition there is going to be 30 days. Okay, but you will have all these contractual rights to be able to pay premium into the future, your whole lifetime. Lots of contractual rights based on the contractual obligation of the premium that you chose to pay. And then the structure of that policy can include, when it does come to the premium that you chose to pay, a certain portion of that premium going to the base whole life policy itself, a portion going to the paid up additions rider that would be on a banking style policy, perhaps also a term rider, and then other riders. And we will cover these other particular subjects on our EncycloMedia series for sure. But the structure of that policy and what percentage is allocated to each of those segments of the whole policy are going to be pursuant to your conversation with your professional. And it is so very important to be talking with someone who has implemented the infinite banking concept for themselves and is helping others do that professionally, such as myself. All right. And then even so, with those different parts, you will have, again, a certain portion that will perhaps go to the base, a certain portion that will perhaps go to the paid up additions rider from the total amount of premium that you are paying. And those splits, and that's just a phrase in this space, those splits between the base and the paid up additions will be what determines the amount of cash value that you have earlier on, later on, the death benefit that you have earlier on, later on, all part of the structure of the policy. And particularly on death benefit, for an infinite banking style policy, the death benefit is typically minimized, not thrown out, not done away with, not completely disregarded. In fact, it's my philosophy and my approach that everyone should have from the start, from the very start, even for implementing the infinite banking concept, an appropriate amount of death benefit coverage and protection. Now, in this structure, there are going to be so many factors that go into what's going to make a policy properly structured for the individual. You are different than I'm different than the next person. So someone's age, someone's capitalization, timeline, their plans, their financials, their purpose, their intent, their goals, their aspirations, all of that should be part of a series of comprehensive conversations around, again, where you're at now and where you're going and how you see yourself using this policy so that that policy is properly structured for you, the individual. And if we're following R. Nelson Nash's principles, the first principle of implementing infinite banking is to think long range. We should be thinking long range even from the very start, even from the very structure of this policy. Yes, a policy can be structured and should be structured, in my opinion, to accommodate for some short-term goals, things that you plan to do within the next 12 months, and yet be built appropriately for your whole life. See, it doesn't matter if you're riding a bike or driving a car. you're going to go where your eyes look. So I believe that's a great reason to remember why Nash talked about thinking long range. Yes, we can accomplish these short-term goals with a proper structure on a policy and the long-term goals. We will not have to sacrifice the long-range goals just for the short term. So the proper structure on a whole life policy is not like going to a box store and asking a box store agent for the smallest amount of premium that you can pay for the largest amount of death benefit that you want to get, but rather it's a comprehensive look at, again, your financial footprint, goals, ambitions, your intent, your purpose, and then finding which company best matches that, which type of whole life product best matches that, and then how that product should be structured for your goals and your plans and your intentions. And then all through just this comprehensive evaluation of you, the company, the product, where are you at in your philosophy and understanding of this paradigm of becoming your own banker, all to make something that is going to be custom built for you, for the individual. Is it going to have the most favorable terms for you? Is it going to have the flexibility that you are going to need in your plans? Is it built for the best case scenario? Is it built for the worst case scenario? All of this matters, and that's not what you get out in the life insurance industry as a whole. This is something very particular and very structured. All these different concepts that go into the structure of your policy, the flexibility of the premium, the duration of time that you will have the contractual right to pay premiums. Do you need term insurance added to the policy as a rider? Do you need some standalone convertible term insurance? And we'll talk about this at length. Again, we'll touch on each of these, but really for the in-depth look at what it means to vet, research, and then own a properly structured whole life policy with a mutual company that pays dividends for the purpose of implementing infinite banking, I would encourage you. We've got several other series on our podcast channel and website. We've got a question and answer series. We've got a financial quick takes series. We've got client interviews. We have our general episodes where we really dive in on the nuts and bolts information of implementing the infinite banking concept, my best practices, life experience, both as a consumer and as a professional. We've got our myths, mysteries, and misconceptions playlist where we cover just that, what the wide world is saying and what they don't understand or what they misconceive. So I hope that this has been helpful to you. If you have a suggestion on what you'd like me to cover next, make sure to put that down in the comment section. Otherwise, you can see all of our information and talk with me from our website, durhamtalents.com. This has been a great pleasure for me. Look forward to our next conversation. Have a great day. Take care.